but it seems like they're fighting deflation, but probably more like deflation of assets, right? So they keep saying they can't get the inflation they want, they can't get it. Well, I think they've got it now. I think it's a little bit over their target at this point, but but then at the same time, we're seeing prices of everything going through the roof, from used cars to used bicycles, all the way to all types of financial assets and all those types of things. So the deflation that they're afraid of, I mean, is that really in the markets? That's what they're worried about: stocks dropping, real estate dropping, bonds crashing, things like that.
They were pretty explicit, a decade ago when they point out that they wanted to do the wealth effect. So they pretty much said they wanted to cause asset price inflation. They just described it a little bit more politely, and so that was their goal, was to basically increase housing costs again, increase the stock market again, and if you do a lot of monetary policy without doing a lot of fiscal policy, that's what you tend to get. Now there were still disinflationary forces over the course of that decade because, for example, about a decade ago you had a period of commodity oversupply. You had the slowdown in China, and so we've been kind of working through this period of commodity oversupply for a while. We also, of course, had the rise of shale oil, which was largely unprofitable, but it still contributed to a ton of extra supply and therefore pretty low prices across the board. And so we've been in that kind of disinflationary commodity environment, while we had a target, inflation in asset prices, inflation in healthcare, inflation in education, inflation in childcare, things like that, where you had, deflation in electronic goods, you had deflation in commodities, deflation due to technology and kind of offshoring, things like that. And so, from their perspective, they would prefer the inflation rate to be higher than the treasury yields, right? Because that's how you can stop debt as a percentage of GDP from continuing to grow out of control if they have the essentially nominal GDP growing faster than the combination of debt issuance and as a percentage of GDP and interest rates. But of course, I mean, that's a really bad environment if you're holding cash or bonds. And so there's no free lunch. I mean, someone somewhere is getting screwed over. Sometimes there are certain policy regimes where the debtors are getting screwed over, and there are other times where the people that own the debt, the creditors, are getting screwed over. And so in this environment of high leverage, they're trying to err on the side of essentially the creditors getting screwed over. But instead of kind of abrupt kind of nominal losses, they'd prefer to basically just fail to keep up with inflation. And that's what you saw back in, say, the 1970s and 1940s, these inflationary decades. Ironically, they tend to deleverage things because the bonds fail to keep up with inflation, but you don't want to be the ones holding those assets, and that's a pretty big pool of assets.
Yeah, definitely. I guess that you kind of talked about that, and that's what I was trying to figure out, is like, what are they trying to optimize for? Because to your point, electronics coming down and deflationary source, things like that. And I guess it depends on which side, as you said, which side you're on, but it seems like that would be good things for most people if prices were coming down. Asset prices, I guess if you're holding asset prices, you want them to go up. If you want to buy them, you want them to be down, right? So I guess it depends. But like overall, it seems like if most people had their cost of living going down, that would be a good thing, and asset prices going up at the same time, that would be kind of a good thing. So I guess kind of the question was, are they really trying? I guess they're kind of targeting the CPI basket, which is like this consumer price of goods basket. But it seems like the big risk of deflation is in the markets. Like stocks could crash 50%, 80%. The real estate could crash 50%. And that's like a massive deflation hit. So you think that's what they're trying to optimize for? I mean, even though they're always talking about CPI?
Pretty much. I mean, they're trying to keep asset prices up. They're also, they're increasingly talking about kind of nominal GDP targeting. Again, trying to have nominal GDP higher than some of those interest rates and some of the debt accumulation levels. And of course, the perspective will depend on if you're the monetary authority or the fiscal authority. So as consumers, we generally would prefer, price deflation while still having our jobs. So we don't want some sort of economic contraction, but we want technology and things like that to lower prices over time so that our money goes further. And that's normally the best case scenario. The only time that's bad is if you have a debt bubble, right? Because then the real value of your debt goes up relative to your incomes and things like that. So if you had avoided that in the first place, then that deflation is really good. But what policymakers are afraid of is that because we've had this this kind of mix of lower interest rates and these different types of policy mixes, we've kind of encouraged this big debt buildup. And now they basically have to, in their view, inflate it away before they can kind of stabilize. And so if you're the Federal Reserve, you're trying to hold yields lower than the inflation rate. You're trying to be accommodative. and kind of trying to balance between causing asset bubbles, but then also not wanting to crash the market. So that's their perspective. And if you're fiscal policymakers, mainly you want to get votes every 2 years or 4 years or whatever the case may be, and you want to avoid rising populism. You want to avoid things like that from their perspective. And so depending on which side where you work, essentially, if you're the Fed or if you're in the Congress, you have kind of two different things you're balancing.
Yeah. So the tools, as you're kind of laying them out, the monetary or the fiscal, monetary being like issuing more debt to the banks, monetary or fiscal actually like putting money out into the streets into kind of people's hands. And it seems like, I guess as a central bank, what's the quote? If all you have is a hammer, the whole world looks like a nail. And they really only have a couple tools. And really it's, monetary tools. And so that's kind of like interest rates and increasing the debt supply, the money supply. But with interest rates, they're already almost down to zero nominally. We can talk about real rates, et cetera, which I do want to get to. But it seems like a lot of those tools, they're basically running out of, right? Interest rates are down to zero, debt's at all-time high, economy's not growing, so the debt to GDP is tough to move. Do you see that they're like running out of tools? Like how much further can this can be kicked down the road?
So for the Federal Reserve, I do view them as towards the end of their rope in terms of tools. And so they really only have two tools at the end of the day. Mostly it's interest rate manipulation and asset purchases or sales in some cases. And they have some other tools around the margin, like lending facilities and things like that. But ultimately, it comes down to controlling the price of money and buying assets. Now, the fiscal authorities, they're the ones that they can say send cash to people, but then they have to issue debt to do it. And so you have I've described it as like, if you have like a movie where they're going to launch like a nuclear missile and like two generals have to like put their keys in at the same time. So I view policy tools and fiscal tools kind of like the two keys there when it comes to generating inflation. And so if you just have the monetary policy, that's not generally very inflationary on its own because you can't directly get money to people, right? So the Federal Reserve can't send money to people. All they can do is control interest rates. And they can increase the amount of bank reserves in the system, but then those get stuck in the banking system because banks aren't doing loans. And so you have reserves go up, you recapitalize the banks, but it doesn't actually get out into the public. On the other hand, the fiscal authority can send money to whoever they want as long as they have a consensus, but they have to issue bonds to do it, and then therefore someone has to buy those bonds, which sucks money out of the system. But then if you combine the two, and the Treasury sends money to people, they issue bonds, which the Federal Reserve creates new base money and buys those bonds and holds them forever. Well, then you're just literally essentially creating new base money and directing it into the economy, and that's how you get, say, the 25% broad money supply year-over-year change that we had, in 2020. And so that tends to be a more inflationary environment, especially if they were to sustain it for several years. And so I think, as we go forward, obviously right now we're having some base effects, right? So we're in say March, April, May, June, you're comparing it to the 2020 period, which was like the kind of the disinflationary crunch they had during the worst part of the lockdown. And so we're going to get some pretty high base effects. Like we're probably going to see, even official CPI, we're probably going to see it over 3% year over year. But then the big question is going forward, what are we going to do with, are they going to do like an infrastructure bill that also gets monetized? Are they going to do another round of aid, things like that? And some of those, if they were to continue, could be pretty inflationary to a certain extent, especially because a lot of economists don't incorporate, say, the current situation of commodity markets. And so, of course, that kind of, say, 15-year cycle of commodity supply and commodity demand has a big impact on inflation. And so when you're in a period of commodity oversupply, as we were for the past decade, that tends to keep a lid on most types of inflation. Whereas when you're in a period of, say you haven't done a lot of CapEx, you haven't kind of brought new mines to market, you haven't found like new big, we haven't done the investment. If you were to get that increase in commodity demand, well then, you have higher commodity prices, and that's where we're starting to see that kind of show up in the market, where many commodities are still below where they were 10 to 15 years ago, with some exceptions like beef, lumber, gold touched new all-time highs. Most of them are still below their all-time highs, but they're starting to break out from their big declining trend they had. And so it does look like the 2020s could be a more inflationary decade with tighter commodity markets, big increases in the broad money supply, and that money getting to people rather than just stuck in the banking system, which of course can benefit some people, but then you have that risk of inflation, where you increase the broad money supply by a lot, but you haven't increased the goods and services by an equal amount.